Hi, welcome to Elevate Market Chat. Today's episode was recorded on March 24th, 2022. Shane and I are going to discuss general markets and some of our thoughts. This is all for entertainment purposes and is not financial advice. Take a minute, read our legal disclosure, and enjoy the episode. Thanks. With that, let's get started. So starting off here, we're looking at SPY. Shane, what are you looking at and what are you thinking?
Well, I'm pretty blown away by the magnitude of the bounce. I think a lot of people are. I don't think a lot of people thought we'd see a higher high yet. So, yeah, I mean, this is the chart we shared last week, and to I guess be clear, I didn't really expect the market to bounce over this level. Once we got up here, that was technically going to be a higher high. On a closing basis, we even sort of made a higher low right here from this one. And so, we might kind of be getting out of the woods on a closing basis. I somehow doubt it. I'm still pretty bearish personally. There's a lot of reasons to be bearish, and of course that's when the market sort of tends to have its most violent rallies. But I was pretty surprised to see it get above this level as well, where we had a double top previously. And so now we're just kind of into a situation where we definitely have made a higher high, and depending on where we end today, we're on our way to making for sure a higher low as well, and the market's trading above this line here, which is the 200-day moving average. So I mean, as crazy as it sounds, with all the things going on in the world and all the entire macroeconomic picture, the market is doing its thing. The pain trade was higher. Everybody was set up for shorts, it seems like, and so we got a big bounce. And once you make it above these levels that people weren't expecting, everybody who's got too much cash kind of jumps in and says, "Man, I better buy this." And then it gives above this level, and everybody with cash says, "Man, I better buy this." And it gets up above the 200-day moving average, and people start hitting the sell button finally a little bit. So we had a little drop yesterday. Market started off kind of dropping this morning after gapping up a little, and now it seems to have a pretty nice intraday rally going on. If you're looking at the 30-minute chart, if I switch over to the candles, this is where we closed yesterday. And then you can see the market tried to go down a little bit at the open, tried to raise to go higher and failed, and then really kind of started moving. Now it's starting to come down a little bit. So see where we end up, but certainly a better place than we were in a week ago.
Absolutely. And I know, looking at some of the leaders that are out there, so Tesla just went on an absolute tear, and then Nvidia today as well. And when you're seeing some of those tech leaders start to take leadership again, it's kind of telling you that people are starting to want to put money to work here. So, backing and filling is normal. So there will be days that sell off and base a little bit. But right now, I don't want to fight that trend, and the trend is up. So
yeah, what are your big long positions right now? It was gold last time we talked, right?
It's still gold. So yeah. I was swinging some call options on GLD and switched over to just holding the actual futures contract. But right now, I was watching on gold the kind of 1950 level, and it broke through that. It's holding it. And today, last I checked, we were a little over 1960. So gold's looking good again. We had that double top on the weekly, but I think that's natural that you can hit a resistance level like that and continue higher. But right now, I mean, you look at that, you had that huge run up, pulled back, caught up a little bit, and now, yep, exactly what you're drawing there. So
yep, that's a pretty textbook consolidation after a pullback. I mean, that's what you want to see before a rip back to the highs.
Absolutely. So, I like gold. It would have been nice to just see it blast right through the new all-time high instead of backing and filling like that, but I can't fight that chart. And to me, it's saying it wants to go higher. And when you have all this inflation out there, historically, this would be a place to go. But if you just go off the chart and knew nothing of gold, this would just be textbook for entering along here.
Yeah, well, you can see I got a bet right here. I don't know if you can see that when I hover over that, it says Scotty owes you a bottle of Duckhorn Cab. So I made a bet with my buddy. I think I might have mentioned that that gold would make a new high before it made a new low. See down here, I owe Scotty a bottle of Duckhorn Cab. So I still like my trade better. I think it's gonna go make a new all-time high. In fact, yesterday before close, I bought AU, I think is the symbol. Yep. So I bought it, pretty much towards the end of the day yesterday, and so far it's gapped up. Looked a lot better earlier. Has since pulled back a little. But I also bought Barrick Gold long, same idea. All the charts look the same, very similar to
Absolutely.
gold. Um, so yeah, the trend is up. The trend is your friend. You only want to be a contrarian at extremes, right? So most of the time you just want to be, oh, that's not the right symbol anyway. What is gold?
And what's
Barrick Gold.
interesting is the conversation
There's
is that
Barrick Gold.
if the Fed is going to raise rates so much, wouldn't that be, a negative for gold? But if you look at, or if you separate the nominal rate from the real rate still isn't, higher than historical norms. So you have all this inflation. Raising the rates doesn't necessarily offset the inflation yet. So that,
Yeah, I mean, just in that, let's see if I can find it. See how many times I said Fed in here. So in my recent commentary, which you guys can find out on our website, where is it? The Fed could raise rates by 25 basis points 5 times, and inflation could fall by half, and real interest rates would still be negative. That's the bull case for gold right there. Doesn't matter that nominal rates are going up. This is the bull case for gold, is that
absolutely.
real rates are insanely negative. So good luck to the Fed. They're gonna have to raise by a lot more than 25 basis points, more than a few times in order to get out ahead of that. And so, what else is funny? People say, a lot of people, I mean, it's just old wisdom, and I don't think it's changed permanently, but a lot of people say, like, interest rates make tech stocks go down. So when rates go up, tech stocks go down. If I look at the 10-year treasury note yield, right, via TNX, and I'm going to make this a line chart. And then if I compare it to QQQ, right, the big tech stock ETF over, I don't know how long this goes back. Let's just say it's over a year. No, not over a year. That doesn't work. Oh, that was year to
Actually,
date.
that's year to date.
Yeah, this is 1 year. So over the past 1 year, the blue line, which is the 10-year yield, which is interest rates, has up 44%. Tech stocks are up 14%. If I go a little bit longer, right? Look at this. Interest rates are up 281%. Tech stocks are up 68%. So whenever people start telling you that, rates up means with any amount of certainty that tech stocks will go down, it's not quite that linear of a relationship. I think it doesn't really matter when interest rates are only, 2%, and real rates are negative, right? I mean, interest rates at 5%, okay, that's a different story. Rates going higher might actually be a problem for tech stocks, but this is still not very high interest rates. I mean, if you can't afford to pay 2% for 10 years, you shouldn't be in business anyway.
Yeah.
So, and in fact, if you look back at when rates dropped from, say, 3% to 2%, everybody in the tech world was happy because they could borrow money at 2%.
Mm-hmm.
It's just super cheap money, no matter which way you slice it. And that's good for companies that need to borrow to fund growth.
And it's always worth mentioning too is, yes, there may be a correlation here, but what's the lag time? So,
Yeah.
Rates could hit all-time highs today. It doesn't mean tech stocks sell off today. It could be a 5-year window. And that's where it's important to actually look at the individual chart for NASDAQ and say, hey, if the trend is intact, ride it for what it's worth, but manage the risk. And eventually it'll catch up. I know you and I keep talking about the yield curve. So I don't know if you want to pull that one up, but
yeah, but first I wanted to look at this one because you said Tesla as if it was a technology stock. First of all, it's an automaker. And it probably doesn't deserve to be up anywhere near as much as it is. But this is what happens. Like something like GameStop over the past few weeks, or not few weeks, but a few days. Look at this thing. It's gone up 93% in 7 trading days. You could look at it this way too. It's gone up 90% in 5 trading days because good old Ryan Cohen bought some shares. So that gets the Wall Street bets people excited. It makes people want to chase a stock that probably isn't worth anything, and chase it higher. I don't know if you guys know this out there, but there were actually 11 people who watched our last video, which is awesome. I was expecting 0, so that's cool. But anyway, some of you out there may know this, but you can actually download video games over the internet, and you don't actually have to go to GameStop and buy a disc anymore. So GameStop's business is probably in permanent decline. Sure, there are people out there who still have old Xbox and old PlayStation systems that would like to go buy used discs, but I haven't bought a disc to play a video game in years. I certainly haven't waited in line at a GameStop for the midnight release of a Call of Duty, since I don't even know when. It's been a really long time. My daughter doesn't even do that anymore. So anyway, GameStop is kind of a joke. And when you see stuff like that happening, I mean, it's happened before. You can see it back here. Big runs and then big drops, big runs, big drops, big runs, big drops, and then, steadily declining, now trading below the 200-day moving average. If this had ran all the way into the 200-day moving average, I'd have been all over the short. I almost shorted it this morning because it looks like it's kind of everybody who wanted to buy on the Ryan Cohen news has bought. And what's the BBBY? Is that yeah, this is the last one I shorted because Ryan Cohen bought it. So Ryan Cohen bought it right here. Ryan Cohen, by the way, is the CEO, former CEO of Chewy, the pet food online retailer. Anyway, it jumped, gosh, I don't know, that from the close of the prior day to the open, it was up 84% basically overnight. I luckily got some shares and shorted them right around, I think it was $28. So I shorted here and I covered over the next couple of days. So on the downside, I made 20 or 25%, I think, on the trade over the course of a couple of days. And then of course, as soon as I was out, it dropped another 16%. So
and then
oops,
Shane,
my bad.
I'm just curious, but what was your indicator on that one? So I'm looking at the volume on the daily at least, and I have to think that the buyers were exhausted. There was nobody left to step in, but were you looking for any type of volume confirmation or anything else to just kind of let you know that it was time to short that thing?
So I swear, I'm not making this up. Like I put setups in every single one of the personal trades that I make, whether it's a breakout or a breakdown or a hedge or a resistance or support. The setup for this one literally says Ryan Cohen sucks. That's it. That was the whole setup. I knew he was buying. I knew nothing had changed about the business. Obviously, you do see a giant spike in volume here. But that wasn't necessarily the trigger for the trade. For me, just seeing something go up that much overnight because some human being is in a stock, that's enough for me, right? That's enough for me to essentially what I did is I sold it, I don't know, let's say I sold it at, I don't remember exactly what it was. It must have been like 29 because to the highs of the day. Yeah, well, no, it might have been 28. Let's see.
And I know on that one, you oftentimes when you have a gap up like that and you don't have follow through. So typically you can go to a 5 or 15-minute chart and see a little basing and continuation. And it looks like that one just never even tried.
Yeah, there's the 5-minute chart. But I think I probably shorted right around here. I'd have to go look at my stats to find out. But here's the deal: is from here, I was willing to risk. I put my stop at the highs of the day. So the highest trade of the new day was say here at 30, right? So if I had shorted it here, and the stock went up to this level, I would have stopped out. So that represents a risk of 6.5%, right? So again, if the stock had if I had shorted it right here or sold it short right here and the stock immediately went up, and as soon as it put in a new high of the day, I would have stopped out. I would have bought to cover my position, and I would have lost about 6.5%. But I thought that the potential that I could make money from here went all the way back down to where it closed yesterday, because really nothing changed. There's nothing fundamentally that changed about the company. The economics didn't change about the company. Bed Bath and Beyond is basically in permanent decline. I don't think you want to be long retail in an environment where oil costs over $100 a barrel and people, aren't necessarily going out and shopping, and inflation is really squeezing a lot of the people who shop at Bed Bath and Beyond. I don't see any good reason to be long this stock. I certainly don't see a good reason for it to change by 90% overnight because one guy who has very little to do with anything decided to buy the stock. And he was advocating that they would sell themselves to another company. Like, who's going to buy Bed Bath and Beyond? Like, who's even the potential buyer for that? And is Amazon going to buy Bed Bath and Beyond? It just doesn't make any sense to me. So, I was risking 6.5% to make 40%. That's a good trade for me. You don't have to be right even half of the time in order to make money on that. You could lose money, lose money, lose money, lose money, lose money, and then make all that money once, and you're still ahead of the game.
Yeah, I think Paul Tudor
just good
Jones
risk reward.
Paul Tudor Jones said it. If he gets paid 5-1 on anything, you can't keep him out of that trade. That is a great risk reward.
Exactly. So I generally like my risk to be a little tighter than that. My average risk on a trade in my personal accounts is about 3%. But really I focus on the overall risk to my portfolio. So I use that to determine size, so if I have a 6.5% risk on a trade, I'm going to allocate less money to that trade than if I'm at a 3% risk on the trade. So always controlling that portfolio level risk in addition to the individual security risk. Anyway, we don't have a bunch of time. I got another live interview coming up in about 15 minutes. So I need to get prepared for that. So I got about 5 minutes left for this phone call. And I do want to get to the inverted yield curve situation. So let me see. By the way, guys, this is TradingView. It's got every chart you can imagine. And I'm going to look for the, I'm going to look for the 10-year 10-year minus 2-year chart, where I just had it up a minute ago. Oh, this is it right here. See, 10-year treasury constant maturity minus 2-year treasury. And oh, so they changed me back to daily, which is fine. So going back to today, right now, if you take the 10-year yield, Kyle, I know you know this, but just for the people out there who might actually watch this, if you take the 10-year yield and subtract the 2-year yield, the difference is 0.20%. Sometimes, rarely, that actually goes to a negative number. So if I put at 0 a line, so that's 0. What happens anytime this chart dips below the 0 bound and the rate goes negative, or it looks like a negative number, we call that an inverted yield curve. And within 18 months, it is very likely that the US economy will be in a recession. And it's not like every single time the yield curve inverts, we see a recession, but every recession has generally been preceded by a yield curve inversion. So try and move that back a little bit. Kyle, you have any comments on that?
So I wanted to ask, what are your thoughts? Why is that? What's the fundamental reason why treasury yield or the curve inversion leads to a recession?
I think the main reason is that banks just shut down operations. I mean, banks are what fuel growth and what fuel lending and what fuel company formation, and they fuel inventory purchases, pretty much everything. And the way that banks make money is borrowing at the short end of the curve, right? So they pay you whatever they pay you in your checking account, essentially, right? At the very shortest end of the curve, they pay you very little for the money that sits in your checking account. And they turn around and lend that money to people who want to buy houses for 30 years, and they charge the 30-year rate. So, banks and that's, that's not exactly correlated to
Right.
this time frame, but that's a good way to think about it. Is if banks can't even make money borrowing at checking account yields and lending at, uh, mortgage rate yields, then they don't lend. And if they don't lend, then the economy sort of just grinds to a halt all around. And that it has a major impact on the overall situation. Another
Absolute.
thing. Oh, sorry. Go ahead.
I was going to say, so to break that down a bit, so the deposit rate, so when you have your funds at a bank, if they pay you 1%, but now you could go somewhere else, say 3% would be a return you could get, you would take your money out and the bank no longer has those short-term funds. So as the short-term rate kind of goes up to say, let's 1%, but now they're lending out mortgages at, 30-year rate at 2%, they're only making a 1% spread. And the reason
Yep.
why they use the 10-year is because you look at the duration. So while it's a 30-year mortgage, the duration or the average time that actually gets paid off on the bank's book is about 10 years. So that's why we look at that number.
And that's why I hired Kyle, because he's smarter than me. You said that well. Thank you. But so, the St. Louis Fed has a great website. It's all public information. They've got some charts and stuff out here. But the last time rates went negative or the yield curve was inverted, right? We had a recession, which is this gray area within 18 months. And if we back that up to be the maximum, you can see that every one of these gray shaded areas, right, was preceded by an inverted yield curve every single time. So, yeah, it's I'll just say it. This is how I think about it. Back in the day when I used to drink, every time I drank, something bad did not happen. But every time something really bad happened to me, I was drunk. So it's a good indicator of an upcoming recession, and it's something you want to look out for. The reason that we're talking about that is obviously the not only that the current 10 minus 2-year rate is only 20 basis points, but if you look at futures or the forward yield spread, right, we are already minus 20. So what this indicates, again, this is from our friends over at Hedgeye, but the chart above shows the expected yield curve in 1 year. So the market is currently pricing this risk in and inverted at 20 basis points. Oh, and look at that. They even say it. While every inverted yield curve has preceded a recession, every recession has, while not every inverted yield curve has preceded a recession, every recession has been preceded by an inverted yield curve. So that's why we're focused on it. And it certainly doesn't mean the market's going to crash overnight, right? It's usually within about 18 months. So we could have a year, we could have longer than a year before the recession finally hits. But with the Fed tightening into a slowing economy, I sort of think it might come a little bit sooner than that. So,
and I think one thing I wanted to touch on just quick is right now I'm looking at oil and right back about 113 per barrel and looking bullish. And the interesting stat is this, that 10% of all households, so not individuals, households in the US earn $100,000 or more. That means 90% are earning less than that. And now when you look at 113 per barrel on oil, that could push refined gasoline up into that, $5 or $6 a gallon by summer. And then on top of that, you add the grain markets. Grain markets are bullish as heck right now and keep going higher. So people are going to be spending a lot just to, kind of get by and pay for just the necessities of life. So fundamentally, it doesn't mean the market's crashing tomorrow or anything, but fundamentally, people are getting squeezed on their pocketbooks, and we'll kind of see how that feeds through the economy. But
yep, corn, wheat, oil, all those commodities holding up pretty well in this inflationary environment. So, but the granddaddy of them all, as we said earlier, is the gold price. So keep your eye on gold, breaking out. Looks like it wants to run higher. All right, man, I got to run. Always great chatting with you, and look forward to doing it again next week.
absolutely. Thanks, Shane. You have a good week.
See you, man.
See you.